From time to time on this show, I've been accused of being very negative about the market, very bearish about the market, which I am at certain times. But if you're a member of the Stock Trader Network, you can look at my portfolio and see I own a lot of stuff, too much stuff, nothing short in there. So I always want the market to go up. And on a day like this, when we get the overnight news, when we're trade much lower overnight and we come back, I'm like, whew, I breathe a sigh of relief. But I don't know. I am certain about the uncertainty in this market. Oil, private credit, a lot of things going on. We're ignoring AI. What's AI going to do for us? But that's why we're here at PreMarket Prep. We analyze all different scenarios, the news in the markets. When you put it to you guys, as straightforward as possible. That's our goal. That's what we want to accomplish. Let's get it started on PreMarket Prep.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Okay, folks, here we are. We are trading in the red only by 40 handles, 35 handles off that pre-market low. Let's defend the pre-market low today, Dennis. The buck is up 8 cents here, 99.06, kind of hanging in there. TLT down 12 cents. We'll talk about that. USO up 581. We'll talk about that. That's 5.5%. GLD and SLV are going opposite directions. GLD a little bit in the red, and SLV up a percent is 78.74. Bitcoin is just, I would say, behaving well. It's not going down, and that's what holders want. So that's it. These charts are brought to you by TradeStation. Born to trade. Chart analyze, customize, all in one platform. Trade smarter, move faster, and stay in control. A system built for serious traders and for traders that want to learn and be serious traders. And let's bring on one of the most serious traders we have in the entire world, Dennis. How you doing, Dennis?
Oh, we're doing good. We're just looking at this market chopping around again here, Joel. I mean, we've had so much chop. We just rallied 35 handles and we just sell off 20 handles in the last 20 minutes. I mean, I think the title of the show is perfect. We're certainly getting more uncertainty here. There's just so much uncertainty everywhere. And that's why when we get these ridiculous Trump pumps, and that's what all these rallies have been, they've all been Trump talking up the market, Trump telling you it's going to be okay, Trump telling you we're not going to be over there very long. So, I mean, these, have been selling opportunities here. We're still trending lower. The trend, overall in the S&P is kind of sideways to down, but certain stocks, man, we're getting to the private credit names, like the BX and the KKRs. They're just a mess. Financials are just a mess. Tech's, holding up well. Some of the tech, software starting to roll over here again. But, uncertainty, especially from the Middle East, is a story here. Brentster, come on in. We'll talk a little bit about the macro
before Brentster
headlines.
gives that Middle East update, I just, I have the honor and the privilege, of being on this show to talk to some really smart people that have been in the markets for a long time. Had Mark Chaikin on yesterday, and his intern could attest to, I've never heard him more cautious. I don't want to say bearish.
It's like subdued a little, right?
Yeah. Yep.
Why? Why is Mark concerned? What was he saying?
Uncertainty. That was really the primary thing. He just, from all his years of being in the markets, when you have these kind of things going on and you don't know when or how they're going to be resolved, it's best, like he's not chasing oil around. He's not going all in on the AI trade. He reduced his exposure to the markets, and he is going to wait for this, to come to pass like we all are, eventually. And he's just, evaluating. He's not trying to predict what's going to happen with the war. He's just, from his experience, caution is warranted here. Is he going to miss a 25% rally in the S&Ps and we go to 8,000, 10,000? He doesn't think so. So he uses his his analysis, his gut analysis, to his advantage, and then he goes to his indicators.
Yeah.
And
and this has been my argument too, where I've been, lightening up, on my longer term stuff, 100% cash in my trading account. I move it in and out, but trading market neutral. And always, I've been getting it back to 100% cash just after 9:30, so I do my overnight trading. But no longs, no swing longs. Not adding really to any long-term positions because of this. We don't know where we're going, and let's just say, we get past the war. Let's just say it is 3 to 4 weeks, what Trump's trying to tell us it is, to try to make the market feel better, which I don't believe for a second. Let's just say, hypothetically, the war goes away. Well, then you have headlines like Team last night, which is completely flying under the radar. So I want to talk this too, and I want to bring it into this because it's an important conversation to just lay out all the uncertainty that really is there. Brentster, do you have the headline for the teams? Because
just want to throw one more thing in here, Dennis. I'm sorry, I did put this in the outline. I had CC on too.
And what's CC saying? Sorry.
He just what you alluded to that and he looks at it on terms of the VIX, and he's like, these 150-point rippers and the rallies that we're seeing, it's just it's scared shorts. And investors are using the opportunity to sell into strength. It's not new longs coming into the market.
Yeah.
And then so you see, we do get these rippers, and they rip.
Oh yeah.
But it's not new money coming into the market. It's either short money or people doing some arbitrage or something of that nature. And he's putting on his hedges. It was fantastic. The show that we do on Wednesdays with CC, you could catch on YouTube. I'm glad a bunch of you guys showed up for that yesterday, because CC just gives us he's so calm, cool, and collected. And look at the market.
He's awesome.
He's not dumping his portfolio. He's hedging, because when the same thing we say, he has a shopping list. And so when he has these hedges on, he's not going to protect his whole portfolio, but at least when he has some of these hedges on is when the market comes in, then he's like, well, I only lost X instead of X. I have this extra cash to deploy into the market. So, just a pleasure being on with those two.
Yeah, guys. Trading it through options is maybe the best way. I just am with Mark, and I'm with what I've been saying too, is I don't think this market's blasting off without us here, because there's so much other uncertainty too, which we're going to get to here in a second. Now. But the Middle East, there's just so much uncertainty. Ships are getting bombed. Like, give us the update. I don't know if you even mentioned that, Brentster, if we had a chance to mention, the uncertainty over there. But 3 ships were struck. We're talking about a minefield over there as well. And the U.S. was confirming this morning that they do believe now that they did plant mines. They were trying to say yesterday that these were old mines. They're saying not the case. Now we're hearing reports that they think they did plant mines. Iran's going to obviously fight back here, and this is what they're doing.
And the vessels that were struck overnight, as far as I've seen reported, we don't know what the object that struck them was. Like, I think you're saying, Dennis, if it was a mine or a missile or something like that. 2 were tankers. 1 was a container ship. 2 were left in the strait smoking. That's the headlines that you're seeing all over the papers today. This is maybe a dramatic, one of our first dramatic scenes, very dramatic scenes from the war. The other vessel that was hit, they put the fire. It was a small fire. They put the fire out, and they went on with business as usual. I use volume in oil to try to give me some indication of how important the market thinks these were, and the market didn't really seemingly think, despite the publications today blasting scenes of smoking ships over in the Strait of Hormuz. The market didn't really seem to, care a ton, sorry to say, kind of thing. But something else that I want to focus on here really quick, the U.S. will release 172 million barrels from its strategic petroleum reserve. This will take approximately 120 days to deliver. I think that's an important timeline. 120 days. some are going to use this as an indication of how long the war could continue, and I don't know if that is, you know, the best case, but you're probably going to see people today, the rest of this week, saying that this could be some indication that the war could go on another 120 days. I don't really have insight on that, but, you know, keep that in mind, folks.
I mean, it's uncertain. That's more uncertainty. We don't know how long this war is going to go. I mean, there was a headline yesterday that they could, you know, potentially, which was a frightening headline. I don't think it's going to happen, but that, you know, they could, Iran could use drones against the West Coast. The FBI was warning against this. I mean, oh my God, if something like that happened, forget about the market. The market's going to limit down. I don't think that's going to happen, but that's, you know, this is more uncertainty to add to it. So the whole Iran situation is huge uncertainty. But we had uncertainty before the war started. This is what I wanted to talk about. There was already the markets, there was stocks getting killed. You know, private credit was getting blasted before the war started. The war didn't cause a lot of these stocks to go down. They were already going down, software names, private credit, you know, some of the financials. Obviously, you know, we even seen the trucking, you know, one day. AI disruption is still coming here. We have Team Atlassian this morning announcing a 10% cut in their workforce, just quietly announcing, you know, 10% cut here. They're citing AI. I mean, this is going to be a theme that is not going to go away. So the war, this too shall pass. We'll get past it. We'll get back to peace times again. You know, we hope that's sooner than later. This AI disruption stuff is not going to go away. Teams are, you know, companies are going to flatten their workforce. And that means cutting jobs, white collar jobs. This is an issue for the market. This is a major issue. We've now seen XYZ do it. Who was the other company? Somebody else, Oracle announced some of it. You know,
Oracle
Meta hasn't done a
talked
lot.
about
Amazon
it. I
cut a
don't
little
know
bit.
if they actually did.
They talked about it though. Like it definitely was talked about in their you know earnings. You know, Mark Zuckerberg used the word flattening his workforce. We know what that means. And now Team, you know, does 10% last night too. Can the market handle 10% reductions to the workforces? Probably. They just can't be like
10%.
XYZ at 40%.
Right.
So, but it's still uncertainty. Like where are jobs going? That problem's not going away.
We were talking about it a little bit earlier, Dennis. You were like, you know, if others besides Block, besides Atlassian do these job cuts, and I think we can be certain about this, that absolutely other companies are going to be doing this. I would say a large majority of companies are. Yeah, it's guaranteed. Why would they not be facing these efficiencies down and deny them? No, this is capitalism. This is the corporate world. This is exactly why they're doing this. So yeah, it's interesting here. And I think, you know, does this roll into another discussion about what's going on behind the scenes? I use that phrase very deliberately in the financial world with private credit concerns. This is also a major uncertainty that is happening out there, and these things in the banking industry and the financial world always happen behind the scenes. It's like the stuff is so cerebral that a lot of people don't really like understand what's going on. And then these things kind of just pop up. We're like, oh no, there's private credit concerns. Right now, they're kind of just bubbling in the background. When are they gonna, you know, make their ugly head known?
We'll bring up the charts of BX, ARES, KKR. I mean, these stocks are down 40% in 6 weeks, 8 weeks. These are, you know, your private company or private credit companies here. These companies, you know, are giving back 2 years of gains here. I mean, when you lift up the hood, like when you look actually at what's going on underneath everything, we've had value stocks holding up the S&P. They really have. They've held it all up. XLP starting to show a little bit of weakness here, you know, because there's a bubble there too. But I mean, you can't lean on staples and drugs and value.
No, not at all.
To hold this market up going forward here. So one of two things has to happen. You've got to get tech to pick it up. And tech, maybe the efficiency trade is going to be the thing. I do think there is a case, I know Citrini put this in their note, that you could actually get new all-time highs based on efficiency. Companies actually going a lot higher because they like the idea of flattening the workforce. That is also not a long-term solution here because jobs are needed. So if everybody cuts 25% of the workforce because of AI or more, which is being threatened here, who's buying stuff? But look at Block, XYZ. This stock has held up very well. It has been very much rewarded for cutting 40% of their workforce. The market likes that. The market is ruthless. The stock market is ruthless. It doesn't give a crap about those people and those jobs. And it's short-term sight. It's short-sighted. It doesn't think, oh, those 40% of people are all of a sudden, not going to be buying as much stuff, and they may be having trouble getting, oh, they'll get a job somewhere else. There'll be jobs. AI will create jobs. Kramer's on there. AI will create more jobs. Maybe it will. It's possible. But you can also see like efficiencies. And with efficiencies actually cost jobs. I do believe you're going to get an AI efficiency trade. I do think some tech stocks are going to be buys. I mean, the S&P has been very resilient. We're 4% off highs. So it's not saying the end of the world is coming here. But what we're saying is there's so much uncertainty here. All I am as a trader and investor is a risk manager. Risk first, then return. The risk is really hard to quantify here. And that's why maybe through CC playing with options, or maybe playing it a little more conservatively, keeping some cash for a rainy day here is prudent right now because we don't know where this market is going. We don't know, where this economy is going.
Okay, we've been doing the show too long because you just took my entire next.
Joel wanted to make that point.
Reiterate it.
No, I mean, well, first of all, this is we'll put I might even draw a smiley face here. I mean, XYZ is holding up, right? After the gap and go. So that's
for
good.
Sure.
And and I think another stock that comes to mind here is something like Walmart, right? I mean, they are using AI.
Here.
They are going to be more efficient, right? Their earnings are probably going to be better because of AI. Companies,
I think so.
You're not going to lose your job to AI. You're going to lose your job to the person that knows how to use AI.
For sure.
And, so that's good. So, we can get another couple quarters, like, oh yeah, reduce costs, better efficiency, better margins. Yeah, we cut 10,000 jobs, that, there's this scenario. So things don't happen immediately. You want immediate, when you have these kind of tests, they take a long time to play out. They do. And we're going to see that wave of efficiency and perhaps even,
and it's going to help the stock market. It is going to help corporate profits. And the stock market, again, is very short-sighted. I'm sorry. It doesn't look out, years. It looks out like what's the immediate concern. That's why you have overshoots, you have exaggerations. The efficient market hypothesis has always been false. Always. With 100% certainty, I can tell you the efficient market hypothesis is false. Why? Because if it wasn't false, I wouldn't be able to have made my entire life off of trading. It wouldn't have been possible. The efficient market hypothesis tells me that I can't make money from trading because all relevant information is always priced in perfectly into the stock market. It's wrong. It's stupid. The market is very inefficient. It's made up of dumb money. Like dumb money drives the bus. And not even, you think institutional money's smart? They don't know what they're doing either. Institutions don't know. They chase price. They're all over, I'll downgrade the stock after it misses earnings. I mean, it's not, as smart as you think it is. And that's why you as traders and why watching PreMarket Prep, we're trying to inform you to make you smarter than the next guy. Because if you're smarter than the other person that's on the opposite side of your trade, you're going to make money. So that's where we are.
Dennis, why do you think then, if that's the case, why do you think there is a efficient market hypothesis?
Because somebody just created it to get their name out there. People just create stuff. Like they come in here and they create this theory and this theory. And they're like, the theory against stock trading, the theory against, investing. It's just like, the economy goes up over time and those stocks go up over time because of that. And there's no outsized moves. There's nothing. It's just all stupidity. I mean, and ask a trader, the one thing is you have academics that write rules. You have academics that propose theories. You know what academics for the most part aren't? Is traders. Traders, you cannot with feel is everything, man. I tell you, when I go away for a week and I'm not trading, I come back and I'm like, I can't get what's going on.
Yeah,
When you're in the gutter and you're on
totally.
there, when you're on the line building the cars, those are the people that know about the cars. They know like what's happening here. They're on the line, they're actually building them, putting them together. They can see what's, efficient, what's not. So, same thing with trading. When you're in there and you're trading and you're in the zone, you're feeling it, you have an edge then. That's, your edge is like
Totally.
being in there and being the feel
Muscle
aspect of it.
memory.
Academics don't have that. Even analysts, because they can't trade the stocks that they're, analyzing, they don't have the opportunity to even do that. So there's lots to think about here. But bottom line, is this market, from my perspective here, just has a random walk all over to it. And that's another theory is random walk theory. The market doesn't follow anything. It just does a random walk. That's the other extreme. But right now we're kind of in the random walk driven by headlines. It's like we're random because we don't know what the next headline's going to be. I mean, 3 ships get, blown up basically yesterday and attacked. I mean, we didn't know that was going to happen. We don't know what's going to happen today. There's going to be more escalation. I mean, we're not de-escalating here yet. It sounds like it's going to be worse. So on headlines like that, the market goes down. On the Trump pumps, which he'll come out, try to talk the market up again because that's his job to try to and it is, to a certain extent. I'm not saying he's not doing a good job. I mean, without the Trump pumps, this market would be a lot lower right now. So in that aspect, he's actually doing a good job by talking up the market.
So we won't be able to get Louis Bacalier on the show, who suggested the efficient market hypothesis in
That's not who,
1900.
Joel went and Googled that.
Okay. No, I just know this off.
That guy's
Okay,
still
my
alive.
head, econ major. I was an econ major. I took econ
this
201
stuff.
pastel.
You know this stuff.
Eugene Fama developed it in the 60s and formally outlined in his paper in 1970. I don't know if we're going to be able to get him on the show either.
Thanks,
And then I didn't have time to who created the random walk, but we'll get to that next time. But let's get back to normal, right?
Well, they want to talk TLT, and it's in this conversation here.
Okay,
too, so I want to talk it too. I've bought some TLT. I gave a case for it a week and a half ago. I've been harpooned by the war. Absolutely harpooned by the war on this. Why is TLT going down in uncertain times? TLT should be rising in uncertain times. People are like, oh my gosh. TLT is going down because USO is flying high. And this is, just obviously a play on rates. And Brentster, I want to just take it to, the Fed Watch tool, if you have it, to show. Because we have seen, the possibility of a June cut go completely out of the window because of oil. Oil rising here is not good for the, the outlook of like, okay, yeah, we have super hot inflation here in oil. Let's go cut rates. So this is what is happening here now. So now the June cut is down to what? 30% chance only of a June
32%. Yep.
Yeah.
July.
So the war trade has not helped the TLT whatsoever. So it hasn't had any defensiveness to it. It is a concern as well. There's just a flat out selling of all assets right now. So it's not even like it's kind of been across the board a little bit in the last, week or so. Not that you're seeing stocks get crushed, but you're down 3% S&Ps. IWM was way up. It's starting to give back its yearly gains here, just slowly leaking here, holding on. The TLT, is back down near its year lows here as well. So it sucks. Does that mean the TLT trade is dead? No, I do believe firmly that we're going to see lower rates in the second part of 2026 and into 2027. So I think long term, I think I'm still a buyer of TLT at these levels. I think short term, out of favor with oil.
We need to we just need clarity on what's going on in the Middle East, because like if we go out to October, which like 2 months ago would have been a crazy thing, we're showing a still 30% chance of no rate cut by October. We're showing a 25% chance of no rate cut at all this year, which is crazy. But when there is a resolution in the Middle East, hopefully soon, these are going to adjust back, I think, more toward normal levels. And, yes, inflation from oil is going to be coming, but we could we have, the odds of a July or September rate cut back on the table in a month or so? I think so. I think so, yes.
There's lots to consider. And if we do have job losses in the second half, and this TLT is a play on this, I think they're going to have to start lowering rates. So my TLT trade, which I'm definitely wrong on right now. Why am I wrong? Well, the market's telling me I'm wrong. I know I'm wrong. I'm down money in it. Do I end up being right though? That's the question. So, I mean, it's down 3%. I'm down 3% right now. It could continue to go down. It sucks. It sucks being wrong. You know what? If I could be right 100% of the time, I've said this before, I would have all the money in the world. You would have none. I would have all the money in the world. It would be a complete dictatorship of everything.
Not getting
that I would
mine.
control the entire world. That if anybody can be right 100% of the time, they control the entire world. That's what it works out to, because you just lever up until you have all the money. Nobody's right 100% of the time. None. Nobody.
I'm wrong 100% of the time.
I'm wrong lots of times. I'm wrong
right.
on the TLT right now. But I think next year I'm going to end up being right. So I'm holding. It's in my long-term account. I have none on my trading account. Not a trade in my trading account. Zero. This is a long-term call. When I made it, it was a long-term call. I think I'm going to end up being right.
I want to just mention, we kind of touched on it before, but I want to just like put it on the screen and just mention it. And if we don't want to talk about it, we can just move past it. But Morgan Stanley has restricted redemptions at its private credit fund following a withdrawal of with a surge in withdrawals. We kind of already had this conversation, but there was news that was related. I just wanted to mention it here real quick.
That's scary. So Morgan Stanley down 2.73%. That's a hammering for that stock. I mean, this is the back to the uncertainty stuff here, Brentster. Like,
yeah,
Morgan Stanley. This chart's a mess too. Financials are an absolute mess. The major problem for this market may be in the financials.
That's
end up like you got KRE down here again too. We end up in a banking crisis out of all of this. Nobody's got that on their bingo card right now.
And that's what starts a lot of major, recession talks, the R word. That leads to many of our crises, a banking crisis, a financial crisis. So
that's the biggest one of them all, always. I don't like the banks at all here right now. It's why it's hard to be chasing these rips. I mean, we rip up to 680 again on SPY yesterday. How many chances do you want to de-risk?
I know. They keep giving us.
It's giving you 100 chances. To be honest with you, I'm talking to everyone in the whole world.
I know.
If you lose a lot of money in this market, you deserve it. Because we've had so many chances to de-risk. There's been so many chances to just, protect yourself. And that doesn't mean just buying puts. And I'm not talking to long-term investors. Long-term investors buy good companies, reasonable valuations. But if you're trading and you're on margin right now, I think you're just in the wrong. The risk is so incredible here right now. You may end up being right.
You can't manage
but the risk reward doesn't warrant it right now. Not from a trading perspective.
Joel, sorry, go ahead.
Before we move on from this, Brian, I just want to tell you back, and I know people have been listening to the show for years and years, but back in April of 23 when we had this banking, I was like, okay, this is a buy the dip opportunity. I need to get in banks. I don't think in the largest position I took was in JP Morgan, and that was just because I didn't think JP Morgan was going out of business. I got tagged minor league on, a real speculative one. I can't remember what it was, but it's SVB maybe. Is that not around? But I picked up Comerica. I picked up JP Morgan. I don't have that feeling right now. I am not out shopping in the banks. I am not out here shopping in the private credit.
People are though, and maybe
I'm not. Maybe it's the right thing to do.
The valuations are reasonable, and if you don't have a financial crisis on deck, I mean, if we don't have AI, I take it back to AI again here, and maybe AI is going to make some of these some of these companies more efficient. I mean, Stephanie Link was talking about buying financials yesterday. Stephanie's smarter than I am. The concern here for me is the wealth management side of it, though. For a lot of these institutions, a lot of these powerhouse financials have huge wealth management, and if AI can do some of that business going forward, that's a ding to the earnings, because these are money where they make a lot of money in wealth management. They make a lot of money there. Do they make a lot of money lending? Yeah, for sure. There's traditional banking, that you can look at that makes a lot of money there too. But wealth management's a huge moneymaker here. I'm not sure that those businesses don't get attacked by AI. Maybe the efficiency is there. Maybe they just become more efficient at it. There's lots to think about here with the financials, but I tell you, the XLF is concerning. The KRE, which is starting to go down here pretty hard right now, is concerning. Looking at these private credit names, it's concerning. There's a lot of things to be concerned about. So again, back to the title of the show, we have certain uncertainty.
Couple things here. We did just get jobless claims. Market doesn't really care. 213,000 versus 214,000 in line. Sorry to jump back to it, but I think Gabe had a great question, just like asking what the TLT is. This isn't something that we deliberately explain, and I think there's probably some other people out there who want us to describe. Said, I know you've explained this before, but I forget, what is the TLT, please?
20-year government bonds. So you're looking at the government side of it. You're not looking at corps. That's why I was intentionally, I'm nervous about, like you could look further and start looking corporate bonds. I mean, they've held up fairly well too, but you go into a financial issue, like if we have, a looming financial crisis here, I don't know if we have that, but I'm just saying the pricing of XLF is starting to concern me. I mean, you don't want to be long corporate bonds, so I stick with government bonds because they're safer. People, the Bitcoiners will say the government bonds aren't safe either. They're going to tell you the government's going to default. There's $38 trillion in debt, and they have no way to pay the TLT 4.47% yield. I'm going to tell you, they've been they've never defaulted before, at least not in the last 100 years. So if you're worried about the government defaulting, we have bigger problems here. If the TLT, the government starts defaulting on their debt, you don't have to worry about your stocks anymore. There's bigger problems here. So that's going to be the last shoe to fall. If the TLT collapses and the government defaults on their debt, you don't have to worry about your stocks anymore. So that's a safer place to be, other than, obviously there's nothing completely safe. Even cash isn't completely safe because you have inflation. So is there any safe place to be? I don't know. But TLT is just, a proxy for government bonds is really what it is. Long government bonds.
Correct. Yep.
And TLT, we got to define this. The TLT is crashing. Somebody's like, I'm so underwater on it. We've dropped 3% here, folks. We've got to give some perspective here. We've had a lot of stocks fall a hell of a lot further than that. It's a serious fall for it. It sucks. It's a big fall. Also, oil went up 60% in the last week here. So some perspective here, please. Because if you think a 3% fall is a crash, you, my friend, have not been in the stock market long enough. You, my friend, have not experienced a bear market. Because you know what? Stocks can fall a lot more than 3%. This is why I keep saying, and warning here, we've not had a serious prolonged bear market in 17 years. We had a quick bear market with the COVID crisis where it fell 30% that month. Yes, stocks fell 30% in March of 2020. That was ugly, but they bounced right back. So buy the dip rewarded again. And buy the dip continues to emerge. Last night it emerges again. You're not going to easily break the buy the dip crowd because they've been rewarded for buying the dip for all eternity. The long-term investor has been rewarded forever for buying the dip. So I'm not going to say buy the dip's going to stop working. It's worked forever. It's just, at certain times, these dips get a lot bigger than we think they can. We're not even in a dip really in the S&P right now. We're barely off the highs. That's why we keep warning flags here, because we've held up so well. I mean, most people are down 4 or 5% on their investments here with all this risk out here. I mean, this is
Look
like
at this.
COVID
Look at this
again.
monthly chart. Look at this monthly chart.
Bring it up.
Look at this. Look at
Where's
this.
the sell-off?
What?
We haven't even
Where
sold
are my
off.
glasses? Oh, I
There's
don't wear
nothing
glasses.
there. We're at the highs. We're basically at all-time
We're basically at all-time high.
We're not the analysts who are calling for a bear market after we've fallen 20%. We're just saying there's a lot of risk here right now. I don't even know if there's going to be a bear market. Like the efficiency trade could bring us back up. We don't know. But as a trader, it's your job to protect your capital first. This is what people don't do because they don't need to in the last 5 years because we've been in a relentless bull market here. They haven't needed to think about risk because stocks only go up. We could throw darts at a dartboard and eventually they just come back anyways. If I hold on long, if I go long enough with my option strategies, if I buy out 2 years, I know I'm going to be okay because stocks always come back. Well, there's periods of time where they can stay prolonged and dip for a while. We have not really had a serious dip here. We have so many warning signals. I'm not even worried about the war. I'm worried about the AI. I'm worried about the AI killing jobs. Because I don't believe for a second that AI is going to create more jobs than it kills. I don't believe it for a second. That's media trying to talk you, to calm you,
I think the
Government trying to
industry
talk
too.
you, calm you. I don't believe it for a second. I think there was going to be a lot of people unemployed 3 years.
I
Where
do
does
too.
that mean for stocks? I don't know.
I agree.
I mean, even halfway, I'm not even going COVID low. I mean, even going
There's
back,
been no sell-off. That's the best chart on the right to look at right now. We're looking at the one on the right. There's
yeah,
no sell-off here. You're still selling at basically all-time highs. I'm not putting on more risk here. This isn't even a dip. You're buying the dip. Is this a dip? Is this even a dip? Maybe on some few names, maybe selective dips. There has been some destruction, but the S&P is not even dipped at all.
okay. Let's look at the Qs real quick. Let's just go broad here because look at the Qs. I mean, come on, you're at last month's low. Come on, let's look at the IWM. Come on, 2-month low IWM.
Yeah, like part of
Laggard.
me wanted to dump my entire position in the IWM. I've been thinking about that from a longer term perspective because I don't know. Do small caps, but do all these companies become more efficient? There's the efficiency argument here too. So it's a weird market because I could totally see, and I am on the fence here. I'm not telling you to go out and sell at all. I'm just saying as a trader, I got to be cautious here. I think that's what we've said the most. We're not betting on the short side. On the COVID, Joel, when we think there's bear markets looming, me and you bet on the short side. I bought so many puts during COVID, during February. Remember we talked about this? February 2020. I loaded up. No, January 2020. I loaded up on puts. I had all the Feb puts because I'm like, this virus is coming and stocks are going to get hammered. February came and the stocks are still at all-time highs. I'm like, what the hell? I'm like, I just had all the premium. I lost on all those trades. I was wrong. I was early on that trade. But then you know what we did, Joel? We went out to June. I bought puts on the airlines and the cruise lines, and I was buying puts on SPY. I was selling off all this other stuff here. And you know what? Then I got paid. And March 2020 was my best month in 15 years. Why? Because I had a whole pile of puts. People lost a lot of money in March 2020. I made a lot of money because it was predictable. It took 2 months for the market to see the virus that was clearly coming. So don't tell me the market is efficient. I kind of feel like we're in the same thing right now. We can see the AI virus that's coming here for jobs.
Oh, baby.
And that's what it is. And we're still sitting here, la, 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 buy the dip, make money. I just don't know, man. I think a year from now, I think you're going to get an efficiency pop. I think stocks are going to pop up, and that's going to be, the time to buy and load up puts. But I'm not loaded puts right now. So I'm not convictedly bear. I'm convictedly cautious. There's a big difference. Convictedly protecting my capital. Big difference. I do think I'm going to be convictedly bear at some point in time, though, and that's coming next year. Maybe
Dennis,
later this year. Convictedly bear. I'm going to be there.
What's the context? I wanted you to stop and explain something. You said with the efficiencies and the small caps, with the AI efficiencies and the small caps, what's the
well, we'd have to break
intersection there?
down. The IWM has 2,000 companies in there. But I don't think for a second that, XYZ is going to be a one-off. I think there's going to be flattening of workforces, and I think companies are going to make more money. So you have half the IWM isn't even profitable. Could AI efficiency make some of these companies profitable? Yeah. That's why I kind of think I kind of think this is my path. And like I'm laying it out here right now because people, I think, the war thing has us down. But I do think that hardware, talking those, but even an efficiency trade could bring us back to all-time highs like late summer. I think we could end up coming back to all-time highs like in the next 3 to 4 months. We hit all-time highs again. Everybody's gonna say, "Oh, Dennis was so wrong." They'll cut this clip because this isn't gonna be the theory. They're gonna post the clip from 20 minutes ago because they won't post the whole thing. But I think Citrini is absolutely right. I think it was Citrini that laid this out, and I was thinking the same thing. Like AI efficiency brings us up to all-time highs, especially on the tech names. That's why I'm not selling off my long-term portfolio. I haven't really sold anything. I sold some software names. And then I think it's going to be we're going to start seeing job losses and more job losses. And then when we get towards the end of the year, job losses are going to be, whoa, we're getting some massive job losses here. This started to become a concern. Then I think interest rates start coming down, which tries to help and keep stocks elevated, help, the people who have bills to pay, lower interest helps. And then, but I think the job loss are going to be massive. But we've got somebody on. We have our guest on here who's I want to bring him, George. I want to bring him into this conversation because George, an AI company here he's running right now. I want to talk to him about AI efficiencies.
Let's go.
George, Kailas, Prospero.ai. Are you on the road?
Can you hear us? Uh-oh.
I am. I'm in Palm Springs, and I thought this was going to go a lot easier, but this internet is being rather uncooperative.
Oh no!
So I thought maybe I could I tried to restart my computer. Some things I apologize. I don't know if this is going to be viable. It seemed fine.
You sound okay.
When I was working.
George, you actually sound good as long as you can hear us because you sound clear. So I think we're okay. So we've been having basically a 30-minute discussion. We talked about the war for 10 minutes, and now we've been talking 30 minutes about AI. And we had a headline last night: Team is going to eliminate 10% of their workforce too because of AI. I have made the kind of the obvious guy argument that I believe there's going to be more companies that are going to lay off more people because of AI. And I believe that the AI efficiency trade could bring us to all-time highs temporarily. But I'm somewhat concerned about jobs in the longer term because I kind of am with Citrini on this report that they issued a few weeks ago that everybody read, that AI in the longer term is going to take away a lot of jobs, and not blue collar, but white collar, higher paying jobs. I want to get your thoughts on this whole thing here, George, because obviously Prospero.ai, you're there, you're in the thick of this here. One, talk about AI efficiencies, and then two, talk about AI in the context of jobs.
Yeah, I mean, I think in terms of efficiencies, I'm starting to see some very interesting data plays in addition to the acceleration that we're seeing on the hardware side. And what I think is interesting from an efficiency standpoint there is I do think we might get to a point where these models are not just brute forcing things, essentially. What we're doing now is like a lot of modern brute force approaches. So I think that's one efficiency angle that I've started to think about more, that not as many people are talking about. And I think that's actually, I was talking to a former head of alternative data at Point72 who brought up that point, and his company is actually really focused on this problem of kind of containerizing data approaches. So I think that's one thing in the efficiency play. I do think that there's more juice. I do think the problem with it and following any of these hyperscalers is it's going to be a lot choppier. And especially if you're someone that uses stops, it could be very challenging. And even if you're directionally right, you might end up losing. So I do think if you're going to buy and hold in the right names, there's probably still more juice in that trade. But I think it's getting a lot tougher. And I think that the second part, I think the job loss is a very real thing. I've been calling the death of consulting for a couple years now, and that's being talked about more and more. You see all these, like, I think when you also see all of these like junior associates in law firms not getting hired anymore, it's only a matter of time before that moves up the food chain. And I think that there's no bigger example. I used to use Perplexity on things like, and I think we've talked about this before, and things like enhancing whisper numbers and creating kind of some game theory around earnings. But the things I now use Claude Opus 4.6 for are far beyond that. There's some really good like Instagram posts that I've seen where it's like, prompt it like this, and you can get really good competitive analyses, DCF models, things like that, that used to be really unavailable to someone that didn't have qualifications and a lot of time. But some really quality value analysis. To give a really concrete example, I was looking at just some of the hyperscalers. And one of the things that I learned in terms of a long-term play was how different Iron's margins were versus NBIS, CoreWeave. I think there was one other in terms of, I believe for the full year, it's going to be like 37% this year, and the forecasted for 2026, I think is 86%. And a lot of that is just because of the change of the product mix. That's something that I only really learned tinkering around with some value-based models around looking at some companies that were very strong in Prospero's signals. And that's when I think, and I've been in AI for 15 years, and I think when I've built models, that is always how it develops for me, where I say, okay, I can organize my thoughts around this. I could build supporting signals, supporting data, and then eventually it's going to kind of take over. And that to me is kind of an inflection point, as I could basically build research reports on the fly that are better than anything I'm reading out of investment banks or even high quality analysts, just by like tugging at a thread and continuing to go like deeper down the rabbit hole. And that's just one thing. But I do think, it's going to come for a lot of these like lower level jobs. And then I think the biggest obstacle is, as executives start to learn how to use it more, it's going to move up the food chain until we start seeing, more one-person unicorn companies.
And what does that mean, though? What does that mean long term? Like, I mean, if you start getting, moving up the food chain, and we lose, the interns come in, and then, the juniors, and now you start losing, corporate executives, and all of a sudden, you've got companies that can run efficiently with 20% of the workforce that they had, previously. I mean, what does that mean in the long term for the economy? Like, is this just separate people? You have the people who can use AI and the people who refuse to use AI, and those people are just like in trouble? Is that really what it is?
I mean, one of the things I've been thinking about a lot lately is the difference between like our new billionaires and like the robber barons, as they were called. And the one big difference that I see, and I kind of thought about this because there's the argument, there's always been a concentration of wealth, whatever. You could say that it's getting more extreme now than it's ever been. But you look at, the Rockefellers, the Carnegies, they were actually not only, doing things like building railroads and infrastructure that was helpful to the country long term. They were actually investing heavily in charities. And I think where you're going with this is the same place I think about this. I think unless there are structures beyond government that start supporting in this new world, population, where whether that's, jobs to build infrastructure or, just more opportunities to balance things more. I think things are going to get real bad. I think there's going to be a lot of job loss. I think we're going to start. We've just seen the start of it, and it's kind of getting scary. And I think beyond, just what we're talking about, we're seeing a lot more AI leaders, kind of talking about that more.
Yeah.
So it's the right topic to be talking about. I think it's not just America. I think a lot of places are ill prepared for how much this is going to start accelerating. But there's going to have to be some solutions beyond, I think a lot of the times, you hear about people that are working 2 jobs to make a living wage. But, now if you think about like, some of the ways that those things are talked about, like, Walmart cashier or something like that, just to pick on another thing that's probably not long in this world before, that's going to be, fully automated, at least automated further.
And it is. It kind of
Yeah.
is. Is there any way AI can create jobs?
Like net jobs, like it's going to create different jobs, but is there a way?
No.
Kramer's been arguing AI is going to create more jobs than it costs. I don't believe that for a second. I want to get your thoughts.
I think if there's one thing I kind of agree with on a theoretical level, is it is true, in the Industrial Revolution, everybody was saying nobody was going to have jobs anymore. And I think that it has been true that whenever there's these technological improvements and people are saying there's going to be no more jobs, jobs have appeared. I will give history that. The counterpoint is, I don't know if you've ever seen the really scary graph of, the S&P going up and traditionally jobs going up from it. And then there's this line where ChatGPT was released, and then those lines diverge completely. It is a truly frightening graph. I do not think there's going to be more jobs. Maybe there's more manual labor to build out, data centers kind of stuff. But even then, robots are the better thing for that too. What are you going to put a bunch of people building these advanced data centers, digging holes, when you could have probably these huge robots doing it? I don't really see where it's coming from. The one area that I do think there will be is kind of I don't know, the shows like Person of Interest, Brockmire, those for people of different things come to mind, where I do think there'll be people needed to interface with other people, even as robots get, smarter and they're taking on more of the labor. There's a funny, kind of joke in that show, Brockmire, where humans come to deliver news that the computer wants them to deliver, and they give and they get more compensation. I do think there's jobs available like that. But I think people like Jim Cramer are going to need to be a little more specific before they talk about I don't think there'll be no jobs created, but I just don't think there's I don't think there's much meat on that bone of there's going to be more jobs created than lost. That's kind of an insane statement.
George, you're a long-term, deep value investor on the buy side turned AI inventor with a mission to level the playing field in finance. I love that. So who are the AI winners and who are the AI losers? And we can go long term. We're not going to come back to you in 2 weeks. We're talking your long term. We want to talk long term here. Who are the winners? And if you have time, talk about some of the losers.
Yes. So, I think the way that I've always thought about this and how we've aligned Prospero, just to talk about broadly who I think wins, it's people that own unique data, and it's people that have trust with their users, customers, whatever, right? And I think you can look at that in terms of as these algorithms converge in terms of how easy they are to access, how cheap they are to run. What's the value there? Data, obviously. And that's why you have all these interesting data plays. Meta and Moltbook is certainly an interesting recent one. But I think the winners on that front, there's going to be, I think, a lot of businesses that don't necessarily exist today that might challenge some of the traditional data aggregators or data ingesters like a Meta. I don't necessarily see that on the horizon, but I do think those are the kinds of businesses that win, ones that know how to collect data in a more symbiotic way. And that's why we approach things the way that we do, that a lot of it has been free, a lot of it has been high value, because we think that trust and that relationship of data gathering and alignment of trust, even if you're just talking about more of the investment banking model that used to exist, where people trusted analyst reports and they were right more often because people were actually sold on that value story. And it created more of a wave, like the kind of wave that we see with Palantir, Tesla. Except I think in the future, just in this industry, there'll be a lot more, basis to around that trust and valuation and a way to explain that. So that's kind of like broadly, I think, where I see the winners. And I think it's going to be businesses that are focused on trust, even in the sense that, like, as things like deep fakes become more common, right? People are going to want to know what you're actually saying. And that relationship of trust has to exist. I think if you're talking about like the actual businesses as they exist today, what I always say, if you're going to buy a company for 10 years, and this is like, this is kind of counterbalance to one of the things I said, but I think there's just too much, there's too much of an entrenched nature to these businesses, the cloud providers. If you just buy Amazon, Microsoft, Google, and hold them for 10 years, I think you're going to be happier with those versus, you might get some of these hyperscalers. You might get a better short-term return. But, and the truth is, maybe one of those players doesn't win on a long-term basis. But you're going to make up enough from the other two that are just going to, continue to own the cloud compute and, like, just the land, basically, the new form of land. I think, like, that's the bet that I would make, as well as, one of our favorite stocks for the last year has been LEU, because they have a unique uranium enrichment process and kind of access to that on an ongoing basis and access to flow. Nuclear is the future. I think betting on the small reactors are a little tougher for me. That's also why we like a stock like ASTS, because I think owning the satellites in the sky that produce broadband, that's a good kind of form of land. And ASTS, they might get acquired by someone bigger. But right now they have deals with Verizon, AT&T, Vodafone, Rakuten. There's a few other newer ones. So I think that if you can kind of own, I'd say, the future of land in this world in some way, and I think the cloud providers are the easiest, safest. These are some ones earlier in the curve that we like. I think those are going to be the winners. I think the only other thing to say is I don't necessarily have an opinion on what robotics company is going to win, but if you have an opinion, now is the right time to make a robotics bet. I don't feel called to make one. I don't feel like I know enough about how the robot industry is going to develop. And certainly there's, like, parts plays to be had there too. But again, I don't think it's developed enough for me to say these are the kind of chips, parts that are going to be winners in the robotic space. I think losers. I think the losers are going to be services companies, and I think we're already seeing that.
Yep.
But software as a service, consultants, I think those are the losers. But one thing that I see talked about that I think is very important for people to think about is, this came up when I was discussing Adobe the other day, and I got questions on my stream. And I think people talk about the next phase of, like, what's going to kill Adobe as, like, some AI enhanced PDF editor or, photo editor or something like that it's just, like, easier to use. I don't see that as the next step. I actually see some value in the software space now, because I think people are calling the time of death on that a little early, and these companies will be producing revenue for longer than I think is being modeled. I wouldn't own them for another year, but I think there's a lot of potential to own these companies for another quarter or two, in terms of we saw it with, we've been into it recently.
Yeah.
And, they even guided down a little bit. They went down a little after earnings, but then back up for that very reason. I think people are like, well, actually, maybe that's not that bad. They did do a double beat, and maybe we're calling the time of death a little early. So I think there's potential there. However, I think what people aren't talking about is I don't think there's going to be this enhancement layer. I think agentic is early right now, but I don't think the next phase is humans interacting with some like easier to use software in the app layer. I think the next step is someone saying, I've got these 3 PDFs, combine them, look at my conversation with this customer, right? Make a new one. Here's your source material. Read these emails, go, right? And that's not Adobe. That's something very different than that. That again, I don't know how soon it is, but I think the other factor that people are missing is even if there was a product today, an Adobe killer that was available, that was easier to use, I think people underestimate the switching costs on the B2B level. And I think there's enough of this like agentic is coming in the air that I just don't see enough large organizations switching to some, better Adobe product or some better SaaS product when there's a lot of talk of these fully agentic systems on the horizon, even though they're not as close as some people think.
George Kailas, CEO, Prospero.ai. And if you get Dennis and I this focused and our ears are perking up like this, George, you're doing something right. I'm so happy you could join us there. We are going to be getting you on again real soon because you got to look farther out. You got to look to the future. And there's no doubt, AI, it's here. It's here to stay. I use it like I don't want to admit how many
If
times.
Joel's using it, that's like something.
All right, George,
Thanks,
fantastic guest. You're the only person that has shirts like that is Brent Slava. So I just want to add that in there. Thanks, George.
It's great conversation. I mean, just to give perspective here, because obviously, I love that at the end. They're trying to call time of death on all these software names. It's exactly what they're trying to do. Adobe, it's over. Intuit, it's over. All these stocks don't die that easy. CRM, ServiceNow, they're all dead, and they're all going to go to zero. Stocks just don't go straight to zero. So, I mean, and it probably was premature to call the time of death on these companies here because obviously software's had tremendous bounce here in the last 3 weeks. We're up over 15% from the lows. Does that mean the long-term trend's still your friend of these companies, though? No, I think, he's still saying next quarter or two, I wouldn't want to own these things a year from now. So he's still saying trouble ahead for Adobe, just not imminently dying here. So it's important to give that context.
I'm early. Better early than late. What do you got for me, Brunster?
I'm looking for news on Poet right now. We got an intern in the STN chat.
Oh, he's like the Poet
here.
guy on the intern. He loves that Poet stuff.
I mean, looking at the chart volume, it looks like news. I do not see news like a release from the company. I don't see a filing. I don't see a press release, but it looks like there's something on Poet. If anyone knows in the chat, we're looking.
Intern, just an incredible STN contributor. Let me see what I can do for you, man. This is wide open territory. And you are rallying. I don't know what the news is. I will just give you this bar of interest right here, and it's right here. I don't know what happened on this day, but that day was a bad day, Poet. Maybe we'll do a little research in the STN room, find out what happened that day. Let me give you the price action for that day, and then we will wrap it up on this show today.
They're presenting somewhere.
I'm sorry?
Poet is presenting today.
Today? I thought it was.
Yeah, no, I think because they just put out a tweet. They put out a tweet just this morning, actually.
Let's see. I'm
at
going
8:08, and it says, "Have you heard about Poet Terralite, our line of multiple award-winning optical engines for 1.6T applications? Will be among the hot topics at OFC 2026." Drop by booth number 339 to learn more about our transmit receive engines. So they did put out a tweet this morning, tweet from the company itself. So that might be the driver here as well.
The high on that day was 872. You had a low of 776. You closed at 837. So 837 is my number. I'm well, I don't know about the oil minister here. EKS is putting in some information here. Iraq is decided to continue producing crude oil. I did see a little spike in the S&Ps. I don't know if it could be attributed to that, but OT overtime on pre-market prep. We'll be bringing Tony Pollock to the stage tomorrow for some extended ticker time. And folks, thanks to the chat. Thanks to Brent. Thanks to Dennis. Thanks to all our contributors. Folks, we're wrapping